Sustainability Hub in association with the National Stock Exchange of India and International Financial Services Centers Authority, IFSCA. This is a special event under the partnership by Buzzonerd and National Stock Exchange of India's Knowledge Series, where we are joined by leading experts from India and from global markets to facilitate insightful dialogue on ESG and to strengthen the ESG ecosystem in India. I also wish to introduce you briefly to the nonprofit organization Buzzonerd, based in Bangalore. It is a leading hub dedicated to mainstreaming sustainability, and it has a global audience. This includes hundreds of startups in sustainability innovation, large businesses, and local and state governments. Buzzonerd engages various stakeholders collectively to take action for positive ESG impact on the ground. My name is Kübra Koldemir. I'm a business writer at a globally engaged nonprofit organization called Sustain Finance. And at the same time, I'm also a sustainability researcher at Arguden Governance Academy, an academy focused on promoting good governance based in Istanbul. Today's topic is impact investing. First of all, what is impact investing? These days, there are a number of ways for asset managers to make investments in a sustainable manner. And one of them is impact investing. As opposed to socially responsible investing or ESG investing, impact investing is different in the sense that it's characterized by a direct connection between values-based priorities and the use of investors' capital. These funds not only report on financial performance, but they also try to generate and quantify positive impact on society. Meanwhile, while sustainable investing has been growing tremendously in the last couple of years, greenwashing is also becoming a major problem in the corporate world. There is an increased focus in the climate change debate on the issue of trust, that the words said and promises made by corporations, governments, states, regulators, and even individuals have to be accurate, reliable, verifiable, and that they need to mean something to investors. Recently at Sustain Finance, we wrote an article on the subject of greenwashing. The name of the article is The Cost of Empty ESG Promises, and it has been published by the Financial Times. It is co-authored with the well-known economist, Dr. Nuria Rubini, and with Paul Smith, our founder at Sustain Finance, who is also former president of the CFA Institute. In the article, we talked about how, due to rising trust issues, regulators and consumers are now reading corporate sustainability documents much more carefully than before. As a result, more and more companies are being caught up in litigation provoked by these disclosures. Recent examples have involved companies as diverse as Vale from Brazil, BP, Volkswagen, and Facebook, as we all have heard in the news. Investors are increasingly liable to challenge misleading information, either through shareholder pressure or by exercising influence through boards or through regulators. People are indeed holding their governments and the corporations responsible, challenging the non-enforcement of the climate-related commitments. This is where impact investing can make a difference, because impact investing forces asset managers to quantify the positive social impact of corporations. Therefore, now, please let's go into details. What opportunities impact investments can offer, and where it can have also limitations. I would like to start introducing now our speakers, and I promise I won't interrupt them. First, I will introduce you to Mr. Mahesh Krishnamurthy. He is advisor at Buzzonerd, and he's also independent director at Yes Bank. So Mahesh, welcome. It's very nice to see you here. How do you think impact investing is currently evolving? And do you think impact investing will gain more momentum post COP26?
Good afternoon, everyone. Thank you for that introduction, Kubra. I also want to thank the National Stock Exchange and Buzz on Earth for inviting me and giving me an opportunity to speak here, share some thoughts. COP26 is, I think, going to generate some different outcomes than previous COPs. And for those who don't know what COP means, it doesn't mean police. It means conference. It's basically conference of the, whatever it is. I forget what the P stands for now. But but anyway, it's just gone by COP. And I want to be sure that people don't think they're at the wrong session here. So the point here is that historically, a lot of promises have been made at these COP conferences, starting all the way from Tokyo to Paris, most recently to Glasgow. I think this time it's different. There's always been the sense that in the past, it was a matter of, yes, impact investing and sustainability will get a focus despite these conferences with a very negative connotation. I think eventually that evolved to a situation where people were saying, regardless of these conferences, and I think this time around, I think there's a sense that maybe a little strong here, but people are saying because of the COP26, things will move forward. So I think COP26 is essentially going to provide strong tailwinds to this whole impact investment movement. Why do I say that? I say that because nations have been bold enough to come out and make pronouncements that are somewhat more tangible, actionable, practical compared to in the past. So you've got, the US government has tied up with the World Economic Forum. You've got race to zero, race to net zero, oil and gas and beyond. And many of these initiatives, I think some 30 countries came out and said that they are going to phase out the financing of fossil fuels. I think some 40 nations came out and said they will essentially eliminate coal-fired power, and it goes on. So I think what this does effectively is to reflect the fact that there is now a reaction, even if one doesn't want to call it proactive action, one can call it reactive, but nevertheless, it's action. And I think what it does is it reflects the groundswell of emotion that is out there with regard to the North versus South debate, where the South is more vulnerable to climate change, where the $100 billion per year that had been promised by the advanced countries has not been forthcoming. The fact that there is no roadmap to take us from here to there. So all of these, I think, have come together, and there's been a sort of a mother of all convergence in these dynamics to create the sense that it has become very, very urgent. And I don't think anybody can afford to ignore it anymore. Now, what does all this mean to impact investment? So Kubra, to your question, I would say that it augurs very well. And I think you touched on this, you talked about trust, you talked about greenwashing, and these are all frustrations. They haven't gone away. I think they still linger. I think there's a lot of confusion around, just what is impact investing, what is sustainable investing, what's responsible investing, et cetera, et cetera. There are these terms. What's ESG? But I think it's important to sort of benchmark against what the Global Impact Investment Network, the GIIN, stated several years ago as an initial marker that essentially said you invest and you will get financial returns, but alongside that you'll get some impact. From there, I think we have progressed significantly to the point where I think the definition of impact investing is much, much more clear. It's more crisp, and it basically says that there are 3 or 4 tenets. One is that it will be for-profit enterprises. A. B, it'll be equity-driven. And C, these enterprises will wear their purpose and stated mission on their sleeves, which is all about impacting society, impacting the environment. So when you look at it in this context, it's much more crisp, it's much more clear. What does this do? This opens up the sources of revenue for investment. It really broadens the horizons, and it enables a sort of a clubbing or a coupling, if you will, between the what you typically call impact investors in a very restricted sense, and traditional investors, which is private equity funds, VCs, and so on. And so it has opened things up, and now we're talking about value creation as opposed to value extraction. And what this has also done is it has diversified markets. So for example, initially impact investors were typically the ones who are early to get in, take the risk, they know the sector well, they do a lot of handholding, they're more patient, and so on and so forth, they think longer term. They jump in, they've jumped into the energy sector, for example, where we're talking about renewable or clean energy. That market, they have helped that market mature enough that some of the private equity funds and VCs could come in because of the validation, essentially credible exits at good valuations, which is currency that the PEs and the VCs can relate to, and the markets can relate to, right? So that's one thing. General partners and limited partners have also now started to converge in terms of their objectives and their viewpoints. GPs are people who execute the money, LPs are the ones who bring in the money. And LPs typically have had a much higher 60,000-foot view of impact investments. Are they as passionate about impact measurement, getting in early, measuring outcomes? They haven't been historically, whereas the GPs, general partners, have been. Now there is a growing convergence between these two constituents, and I think that is helping a lot as well. And I think the other thing to keep in mind is the fact that the impact investors go in early, they validate, they seed, they help grow. Then the traditional market-oriented investors come in and help grow and scale. And so that is what we're starting to see. And we're starting to see that in other markets that are now being validated, for example, agriculture, financial inclusion, edutech, and all the rest of it, right? So I think this is all very good news, and I think it is being propagated and pushed by the groundswell of sentiment that now resides, asking for more transparency and asking people to get more serious. So my response is yes, COP26 I think has been a favorable event this time around, and let's wait to see what the roadmaps look like and all the rest, but I think there will be tangible on the ground impact.
Okay, well, thank you so much, Mahesh, for all these insightful comments and also some summaries from COP26 too. So that was very helpful. So let's move on to our next speaker. It's Mr. Damandeep Singh. He is former director at CDP India. Damandeep, welcome to our panel. Now, my question for you is, in your opinion, what is the evidence that impact investing is striking roots in India? Is that happening?
Kubra. Thanks, Kubra, and thanks for inviting me, and thanks to Buzz on Earth for inviting me to speak at this prestigious event. It's essentially, in terms of figures, if you see, Kubra, despite the pandemic and the slowdown and so on, the environmental sector, specifically action on climate change, seems to have grown exponentially. This is a JP Morgan figure that ESG bonds itself last financial year were something of the equivalent of 1.3 billion. And this financial year, it's already crossed 8 billion in bonds that have been issued. So there is definitely a movement towards that. And there is some talk that investments can grow up to 2 trillion by 2028. Asia is still short, and US and UK, of course, the opportunities are huge. That's sort of one aspect. The other, in terms of just ESG funds that have been launched in India, 8 of the 10 ESG existing funds, there may have been more, this is a figure from a couple of weeks ago, have been launched this year alone. So, this is the thing. So there seems to be this rush towards ESG bonds and money and so on, including by banks like ICICI that do not even disclose their own climate impact in the public sphere. So, there is money coming in and people are launching these things and so on, which is all very good. But, that's what refers to the point that you also made and Mahesh also spoke about earlier, is that there is need for greater integrity and accountability now. What does this mean? I think SEBI has also sounded a word of caution and is coming up with rules that are going to be framed around ESG products and so on, so which is very important for the investors, that you need to understand what is ESG, what are you doing about it, where is your money going? The important aspect, if you followed COP, as Mahesh also gave a summary, is that it's really, there are different analogies, a tale of two cities, a tale of two narratives, a glass half full, half empty, because, there was no movement on loss and damage and adaptation, or there was just talk and also about finance that was promised. But on the other hand, there was a great deal of movement. And if you listen to some of the COP roundups from some of the European bodies and agencies, they seem to think that a lot more than their expectations have been achieved. So there is still this different understanding. The biggest, I think, is, of course, the setting up of the IISB, International Sustainability Standards Board, which will now try and give some structure to how the reporting and monitoring of all this happens. And that leads to the point of accountability in terms of what are people doing, and that's becoming the most important issue also, that you refer to green washing and so on. There have been more than 8,000 commitments to net zero at the COP. Okay, that was the last figure. But now the point is that needs to be investigated and to see how true are they, what are they really on the path and so on, and to see where do we stand on all this. So that's sort of the landscape of where do we stand and what is the impact investment that's happening. The other side, of course, is that now companies, and there have been certain bodies that are coming in that are helping companies on their ESG journey, and investors that are working on those. We, when I was at CDP, we did several events where investors came in and did workshops with companies and said, look, you need to start disclose publicly and to understand where you are, because that's what they're looking for. In the initial stages, they're looking at just this ability to disclose, and also what are your targets going forward. It's not just backward looking, but future looking. How are you, what impact are you going to, what do you perceive that you will be having on the environment? What are your climate risks? Where are you headed? And what are you doing about it? They weren't very worried about where you stand, but most of it was, what is the general movement of direction? Are you progressing? Are you thinking, and so on? And it's important to note that with the companies that are disclosing and so on, so they are 99% of the companies that disclosed to CDP in India last year had board level oversight over their CDP responses. So it is becoming an issue that's going right up to the board. It's not just limited to sustainability and reporting and preparing a report. So boards are having complete oversight on it and so on. So that we can discuss that in greater detail.
Mm-hmm. Wow, that's wonderful. So thank you so much for this also local insights, which are very helpful. Our next speaker will be Mr. Abhilash Mulakala. He's Deputy General Manager at International Financial Services Centers Authority, also called IFSCA. Abhilash, could you tell us, please, the role of the regulators in facilitating flows into the green and sustainable projects? We are very lucky to have you to also, get some insights from regulators' perspective, which is very key.
Well, thank you, Kubra, for the introduction, and good evening to the other panelists and the audience. And it is indeed a pleasure to have this conversation with the experts, like in the panelists. And Mr. Mahesh has mentioned about the COP26. One thing that is sure about COP26 is there is an increased commitment from the world, especially India. And financing is going to be key aspect to meet these commitments. Just to give a small fact, like an IFC report has recently mentioned there would be an investment opportunity of about $3 trillion in India in the sustainable and green space. And now, like in the financing, public financing is not going to be sufficient to fund this. It is the private financing that is going to play a very, very key role in meeting these targets. And for increasing the capital flows, both from the domestic sources as well as international sources, there needs to be two enablers from the regulatory perspective. One, free, fair, and transparent financial market. Two, investor confidence. Now, this is the place where regulators play a very, very key role. We're talking about impact investment. Impact investment can be in many products. And it's important to have regulations in these different financial products that are catering to the impact investing. And I'm going to talk about from my experience at IFSC-A. Now, IFSC-A has recently released regulations on a unified listing framework, which includes a separate section on ESG labeled debt securities. Now, like one of the key components in this aspect is the issuer should release allocation and impact report every year until the full allocation of proceeds. Now, these kind of regulations would increase the transparency in the market and allay some of the fears of the investors. And now they have the full view of what is being allocated, how is it being allocated by the issuer. Now, like I'm going to end on a positive note. Like the regulators, Mr. Damandeep has clearly asked that there should be an increased role of regulators, issuers in creating the investor confidence. Now, like regulators internationally and in India are working on many aspects, not just in the bonds which have become popular, but also on banking products like trade financing, how to categorize something as a green trade financing. How do you like? There are so many funds that have grown up like with ESG themes. Now, how do you make it consistent and comparable across in these funds, ESG labeled funds? That's what regulators are actively working on, and I really have a positive outlook on that. Thank you.
Okay, wonderful. Thank you so much for the regulator's perspective. So I will move on right away to our next speaker, because I saw also that some questions may be coming up. So I don't want to take airtime, just to make sure that we can also answer questions. So our next speaker is Mr. Tirthankar Patnaik. As we all know, he's a chief economist at NSE IFSC, and it's great to have you here, Tirthankar. And we are looking forward to the perspective from National Stock Exchange of India. So what do you think is the scope and potential for impact investing in India? Maybe, you can just kind of sum up your thoughts, and especially given that in NSE's perspective, you deal with so many corporations, large corporations, and if you could maybe put them a little bit together for us.
Thank you, Kubra. Welcome, everyone. The importance of impact investing and the scope for impact investing has been well articulated by my fellow esteemed panel members. We have seen how, as Mahesh pointed out, impact investing has taken up a position or role hitherto unseen and unheard especially after COP26, where now there is an increased and I would say strident call for countries to sort of come together. The realization that commitments from the north, as to speak, in terms of transfers, have not really happened. There have been only, I think the $100 billion number that we were, speaking about. I think the numbers that were eventually reached were about $87 odd billion, and there is a significant shortfall. There is a move away from these transfers as I would say some sort of aid to now being seen as something critical, an investment that is critical for a sustainable future for the entire planet. So if you have a realization at that level, I would say there is progress. While there were mixed news about COP26, I would say between Tokyo, Paris, and now Glasgow, one has come a little forward. We saw India commit to a net zero by 2070. That was a significant pledge. How significant is India? In purchasing power parity terms, India today contributes to about 11% of the global incremental GDP. 11%. That makes it the third highest contributor to global GDP after China and the US. So any commitment from such a large country towards net zero has to be seen in the seriousness that it deserves. Now, what is also made amply clear is that investments or a realization towards climate change has to be made feasible, has to be brought in, and this is where I think what Mahesh pointed out has to be seen. Let me just say that if you make a duty also profitable, nothing works quite like that. So the concept of impact investing therefore does bring diverse classes of investors together. You have a set class of assets which are beneficial for the society. There is a clear mandate that investment in them does benefit for the society, and if investment in those assets comes in and sees fruit, then you have met your goals of profit as well as duty to the society and social awareness. From this perspective, I think impact investing started in India. There are papers that say from Amul, the milk cooperative set up by the Gujarat government, Anand, way back in 1946. Amul is one of the largest milk marketing federations in the country, and now it's also, I read that it's venturing overseas. In terms of investments into impact investing in India, there was this McKinsey report that said we saw about $5.2 billion come in between 2010 and 2016. But then that's 2016, and 2020 saw more than $2 billion come in just in 1 year. And 2021, in the first 6 months, we saw $1.2 billion. So, and again, in terms of number of deals, 2020 had about 200 plus deals. You have to see that the ticket size here is relatively small. And but 2021 has got $1.2 billion in 85 deals. That tells you that the deal size is also sort of increasing. There is now an entrenched class of investors that has come into impact investing. And Kudra, if I come to your question about the scope and potential for impact investing in India, India needs more investment than the world can give it and it can make. So we need a significant amount of investment, not just in total, but if you look at the societal goals, if you look at the current economic status of the country, impact investing is something that's needed at a very, very granular level in this country. And the more that can be done, in terms of bringing in either foreign capital, domestic savings in a particular sustainable channel, and in a way that Abhilash so rightly pointed out, that ensures transparency, that ensures credibility to this new class of investors. I think that is where the challenge of impact investing would really lie. And for India, over the next decade or so, one has to make impact investing, investment numbers, not in $1 billion or $2 billion, but 10 times that every year. So that's the amount of investing one would need, and one needs that kind of framework if we are to sort of think about meeting the UN SDGs in a sustainable manner over the next decade or so. I'll stop here for now. Thank you.
Yeah, thank you so much, Tirthankar. It's absolutely true that in the last COP26 meeting, obviously, India has, I think it has been seen as the country that has made one of the biggest pledges for the future, while some people were not as much impressed, for example, by Brazil or by the United States was so-so, but I think people really strongly thought that India's pledge was a very positive note. So hopefully the investment, as you mentioned, will also come with it. And as you also all know, I'm sure during the meeting, also it was discussed that the promised funds from the developed nations to emerging market countries should also be they are feeling now more liable actually to deliver on those. So hopefully that's also going to be part of the solution. So I will move to the next round of questions, and this is where I will ask Mahesh for his next question. I will be back with him. At the same time, I also want to mention that I received 2 questions and that from audience. So I will also start integrating them into the next question round. Mahesh, in your opinion, are there any lingering myths also that surround impact investing? And if you think that is the case, can you kind of mention them and enlighten us a little bit about what they could be?
Thank you, Kubra. I think indeed there are many myths that don't hold true when it comes to impact investing. I was just reminded of something when Damadeep mentioned 4,000 commitments or pledges. One of them, interestingly enough, was made by leading financial institutions at the COP26, where they said they would pledge 130 trillion with a T dollars towards achieving zero on carbon. So, if even 5% of that can be achieved, wouldn't it be something? But anyway, indeed, many myths. I'll try to touch on those that are a little less scary. There are some very scary ones out there. Look, one of the myths, one of the more obvious myths is that impact investments typically yield much lower returns. Now, they yield lower returns, but it's not a typical case that they all yield lower returns. I mean, there are examples, real life examples where, and I think this would probably pertain to India. I can't speak for all markets, but in India, the median IRR, internal rate of return on impact investments is probably around 10, 11, 12%. And if you look at the top 30%, the top 1/3 tier of impact investments, they probably generate 30% plus. Now, some of you may be shocked by that, but that's actually the case, right? So impact investments don't necessarily yield low returns de facto. So that's point number one. And if that had been the case, we wouldn't see this flood of interest from VCs and PEs and so on. So that would be myth number one. I'd say another myth has to do with this notion that somehow as deal size grows, volatility and risk reduces. I don't think that's the case at all. Impact investors, those who step in early and who take all the risk up front, are very talented, very smart, very clever people. And usually what they do is they mitigate the risk. They flatten out the beta that's involved in these investments and essentially lay the groundwork for the growth and the scaling. And the growth funds and the scaling funds usually come in when the risk is a little less, right? So seed, VC, PE, and ultimately it's scaling. And so I think as far as impact investments are concerned, even small ticket size deals can be less volatile than some of the big ticket deals that are out there. So that's another myth. I would say a third myth is probably that that impact investments require extraordinarily patient capital. Now, again, that's a stereotypical impression out there. But the reality is that if you look at the average exit, an average exit period for a PE or a VC is 4 to 5 years. Sometimes it's a little longer, 6, 7 years, depending on the situation, the case in point. But on average, the successful exits from impact investments are around 5 years. So it's really no different. And certainly in certain sectors where there's significant growth, and I know Tirthankar would know what those sectors are, but you look at agri, edu, healthcare, financial inclusion, MSMEs, and so on. The kinds of exits that we're talking about, and there have been many now that have validated this notion. So it's all very good. It's very positive. So that's another myth. I can think of several. Another myth would be that impact investing is only for impact investors. Mm-hmm. The fact is that now what we're seeing is that even foundations and philanthropists are starting to inculcate in their own thinking this notion of impact and measuring impact. And I think that is fabulous because it opens up the vista for some incredible collaboration and for incredible clubbing deals where you can have philanthropists, you can have PEs, you can have VCs, you can have impact investors who all come in and essentially make 1 + 1 = 5, not even 3, right? So that's another myth. And I suppose the last one that I'd like to mention is that impact investing is an asset class. It is not. There's nothing further from the truth. You can be an impact investor in the market, in the listed market. You can be an impact investor in the private equity space. You can be an impact investor in the VC space. You can be an impact. You can go all the way from the hard-nosed expected market returns to loans, soft loans, all the way to the other end of the spectrum where we're talking about foundations and grants, right? So it's all about the lens through which an investor views these different asset classes. So the asset classes are the spectrum of investments that sit in front of you. The lens through which you see those investments is what impact investment is. And so you could decide you want to be concessionary in your expected returns. You could decide that you want to be very hard-nosed. You could decide that you don't want to invest in tobacco or oil or alcohol. Right? So those are the lens through which you're viewing the investments. So these are some of the myths that come to mind. There are many others, but these are the most salient ones that I would like to say are myths and do a disservice to impact investment. I will leave it at that.
Thank you. This was very thoughtful. Thank you. So I will move on straight to our next speaker again. So Damandeep, now I have one question for you myself, and also I have one question for you from the reader, okay? Which I thought you would be an excellent person to answer. So first of all, my question is, in your opinion, what are the drivers for corporate climate action, especially in India? And do you see any sectoral trends and preferences that are emerging? And at the same time, we received from our reader this following question. How do you pivot and model sustainability in the biofuel sector? So the question would be specific to biofuel sector. And how do you raise private funds to scale it up? So I thought, because of your local knowledge in India, I think you would be a great person to answer this also.
Thanks, Kubra. I'm afraid I do not know too much about biofuels, but I'll try and answer that a little bit towards the end, think about it and so on. But let me come to your question first. The drivers for corporate action in India, what we find is actually two. One is which is now being termed impact investments, but it's always been investor queries and investor pressure. When I was at CDP, and one of the CDP's USPs, when we go to companies to ask them to disclose. You're saying you're not disclosing to CDP, you're disclosing to these 110 investors that have over $100 trillion in assets under management that are looking for this kind of information. And we've come up with a system of standardized information. So rather than these 500 odd investors writing to you individually, if you report to us, you would have met all their criteria. And then you can, even further investors, you can. That's one. The other is, of course, supply chains. Now, it's interesting to note that India's fantastic pledge at COP26 is a reduction of 1 gigaton by 2030. You know who else has a target of 1 gigaton reduction in CO2? That's Walmart. And they also have a website called Project Gigaton, where you can actually see what they're doing. And that comes from, them being a supply chain member of CDP. And Walmart actually doesn't produce anything, right? It buys goods and brings it and sells it. So their action is going to happen through the supply chains, through the value chains, as it's called now. So they're asking companies that are in their value chains, that are supplying these products to them, to help them achieve that target. And they're facilitating that. Similar, Microsoft, okay? And they give an annual award in supply chain for which India's top IT firms for several years, it has been Infosys that's been getting the award. And that is all the top India IT companies are actually in the supply chain of Microsoft, Dell. And so they are required to perform. Now, we say we are a voluntary, CDP is a voluntary platform, but is it really voluntary when your buyer is asking for that information? So these are the two major drivers. Now, impact investment, yes, philanthropies are also getting into it. And they're asking companies and they're facilitating companies to do that, to help along that action. The other major thing that's happening for the last 3 or 4 years is what we call is a non-disclosure campaign. And I will put a link from the CDP's website in the chat here for people that are interested. So of these 500 investors that sign off on CDP's questionnaire and endorse it before it goes to companies, about 20% of those are now becoming more active. They are actively, and there's a list of those in that, and as well as the companies. We've come up with a high emitting companies list, and they're actively writing and engaging with those companies, saying, why aren't you disclosing? We need that kind of information. So they're not just signing off on the question at the beginning, but they're also intervening in the interim and asking these companies to take action, saying, you need to do this, and you need to do this. And please, if you're not, we need to understand why. And in some cases, it says, no, we can't do it this year, and we'll do it next year, and so on. So we've actually seen a lot of movement at CDP of companies that are disclosing. So for instance, first year of pandemic, last year, we thought we would see a drop of 25% response rates in the companies. It grew 17% in India, 14% globally. So nearly 60 of the top 200 companies on the stock exchange responded to CDP. This year, that number has grown to 89. Okay. And so of these, we can easily attribute at least 4 to 5 companies each year to the non-disclosure campaign. And there's a report that's analyzed every year and so on. And I'll put the link to the page where you can find all this information. It, of course, pisses off a few companies as well. I'm sorry for the language. It makes them a little bit upset. And so we've had 1 or 2 companies over the years saying, how can you do this? And so on and so forth. But, it's driven action and so on. The other point that I'd like to make, and let's take some names and so on, what is also happening is that now investors are asking for specific information on specific sectors, mostly on the hard-to-abate sectors. So CDP, about 5 or 6, maybe 7, 8 years ago, started producing sectoral reports for the auto sector, for the steel sector, for the cement sector, and so on. And let's name names. I'll give you examples. Tata Motors in 2016, of the top companies in the world, was at the bottom in the 2016 report on the sectoral analysis. Okay. And I remember having detailed discussions on those and so on, and they were very upset about it, naturally. And they said, what is it that the main factor where they were, and was that they did not have a market-ready EV at that time. And this was a chicken and egg issue. They said, look, this is, there is no market for it, right? So when there is a market, we'll produce one. The point is, how do you create a market? And now we're in a stage where Tesla's valuation is more than Volkswagen. So, do you want to wait to create the market, or do you create the market alone? So, that led to certain discussions and changes and so on, so much so that 2018, they rose from 12, 13 figure to number 8. And to a situation now where they're actually spinning off a separate unit for EVs, and Tata's EV in the market is actually the number one EV in the country right now in four-wheelers, passenger cars, Tata Nexon. You have a wait list of 3 to 4 months. If you want to buy one, you have to go and pay a deposit and wait for that. And then, so much so that a few months ago, they have had a PE investment of over $1 billion. So, there are similar cases. If you see, and if you heard yesterday on the Financial Times, the CEO of Tata Power was speaking, and they are trying to say that no new coal investments and all new investments are in renewable. So you see the whole group, more or less, is now moving in completely in the green direction. So this is, there are these very happy and clear examples, similarly from the JSW group, and there are some of the others and so on. And there are a lot of commitments that are coming out of India. 64 of Indian companies have committed to science-based targets, but only 28 odd have specified those targets. So it's also an opportunity to work with them, but they see the light and they're moving on those. So the sectoral analysis, I can give you examples from the cement industry. In 2018, we did a report at CDP wherein 3 of the top cement companies in the world were India. Dalmia was number 1. So, there are a lot of these examples. And so these are the drivers for change. So much so that the CEO of Dalmia Cement was actually also met Mr. Biden at COP, and he's been, part of the group that is known as the First Movers Coalition, wherein these companies that are right now in this technology uncertain world, or technology which is not yet commercial, but are committed to taking action, are willing to take the risk and come out in the open and to say this. Okay, so these are the examples on that. Now coming to biofuels. Biofuels will be important, but in a country like India, wherein there is, we have excess food grains, but there is also the issue of where it's grown, how are those resources consumed, and so on. Government has had a policy of blended ethanol to almost 20-25%. I am afraid I'm not following it very closely. That seems to be a promising endeavor, which will also help reduce India's emissions. But I'm afraid just beyond this cursory knowledge, I do not have too much information on that. And if there is the questionnaire would like to engage with me further, I'd be happy to help them and point to certain resources on that. Thank you. And I'll put the link to the non-disclosure campaign in the chat here for anybody who's interested.
Okay, wonderful. All right. Thank you so much, Mandeep. This was, first of all, a lot of insight on the local corporations in India, both positive examples and more challenging examples. So I'm sure this was very valuable for our listeners. Now I will move on again to our next speaker, Abhilash. I'm back with Abhilash. Again, I have one question for you from me, and then also I think there is a good question for you here also from questions that are coming up from our listeners. So first of all, could you again share the regulator's perspective, which we are very much looking forward to hear? There are many challenges for investors, including lack of standards and strong metrics for ESG. First of all, how do you address this? Could you first let us know about that? And then I will have a second question for you from our readers.
Sure. Forgive me for my voice, like it is due to cold, it is also due to climate change, which is something that we are discussing right now. And to address the question, Kubra, I think you have rightly mentioned that there are many challenges for the investors, especially in the terms of standards and metrics to identify, to be consistent. And you have rightly mentioned so in your introductory speech that there are fears from the investors because of instances of greenwashing in different countries. And this is where I think both the government institutions, regulators, as well as private organizations like standard setting bodies, as well as ESG rating providers would have to act soon, and and I'm hoping they all are going this direction currently. And to be frank, like I would like to draw parallel with the financial accounting. Like so many years ago, financial accounting was not standardized. Now with the initiatives of the governments as well as standard setting bodies in the accounting space, now the financial accounting is comparable, consistent, and standardized across international jurisdictions. Now an investor internationally can invest in any particular jurisdiction and feel confident about it, and they can analyze the metrics through the financial statements. And now, like the environment and social is very different, and it's even more challenging than the financial accounting. Like there are differing opinions even on the definition of what is a green or a sustainable activity, and what are the metrics that are going to define the impact on climate. So these are very challenging questions, and but the world is moving in the direction to get to that state where we can define standards and metrics for the investors. For example, like EU has taken a lead on creating taxonomy for the European Union, and now India is taking steps towards that direction to define terminologies, to create regulations so that enough disclosures are made, and even so regulators like us, like IFSC, international regulators, are taking inspiration from international standard setting bodies, like in the space of like which I mentioned before, like green bonds, social bonds, and drafting regulations. Like and yesterday, I think IOSCO released a recent report on roadmap and the recommendations of ESG ratings or ESG service providers, and it is in the financial benefit of ESG rating providers to converge their methodologies and try to address this understanding of what is the right metric to understand the impact on the climate of your investments in an entity. And Mr. Damandeep has I like the point of Mr. Damandeep where he says that the private organizations are influencing each other in creating in asking the entities to move towards assessing their risks on the climate, assessing their impact on the climate, and that's a good move. I think the world has acknowledged that there is climate change, and we have to address it soon and faster. And both the government institutions, regulators, as well as private organizations are fast moving towards the direction. And like in the case of financial accounting standards, I would say we would soon be seeing standardized metrics, standardized and standards, so that investors will have that comparable and consistent view for investment, and I hope for a world where the fears of greenwashing would be reduced.
Abhilash, I have one question. Somebody, her or his name, Shurojana Patruni, that's one of our listeners right now. And basically, the question is also about impact investment metrics. Would that be, I mean, what we're talking about right now, can we define it as impact investment metrics, or should we, right now, are we not there yet? For impact investing, the metrics, is that still evolving? I mean, what you are describing right now, is it more general metrics that you are talking about that kind of is aligned with global standards, or can we talk about something that is specifically called impact investment metrics?
So, as one of the panelists mentioned, impact investing is not a single space. You have a whole set of asset classes, and you can invest in the entity, you can invest in the bonds, you can invest in equity, you can invest in funds, and there are so many aspects. So I like, my personal opinion, is that there is nothing. I would not define something as an impact investment metrics, but we need to have metrics from the issuers. For example, how much metric tons of carbon dioxide is being emitted. So Those are the kind of metrics that would slowly define, but these are very specific to each sectors. So those are the metrics that are going to be designed, and there will be convergence, and expect a convergence in those kind of metrics, so that there is a clear view to the investors.
Okay, wonderful. Thank you so much. Okay, perfect. So now I will move to Tirthankar, yet at the same time, I've also received a new question for Damandeep. So, okay. But let's just stay with the sequence for now. So I would love to move to Tirthankar. I have one question for you. Could you please share your thoughts on what are the main challenges that we need to overcome for impact investing to become more mainstream? And also from our listeners, from Shalini Kalrash-Sashi, I hope I pronounced it correctly. The question is, what are your views on a social stock exchange? How do you think it will help promote impact investing in India?
So I think the challenges to impact investing in the country were addressed meaningfully in what Abhilash just pointed out in terms of standardization. I think that is the key. Standardization is the key towards and the parable that he gave, the example that he gave of financial accounting, couldn't be better. Standardization of financial accounting has allowed analysis of companies across geographies, across sectors, and in a meaningful way, and has also brought out a significant, jump in the transparency of, reporting financial performance. One has to see something very similar, come here. One has to see basically, how the common investor sees a similar ecosystem of normal equity or debt investments, the same into impact investing. Now, how do you do that? There is, and let me try and answer the question that was raised here as well on social stock exchanges. So one of the recommendations that the SEBI appointed committee of on social stock exchanges said that such as SSE, I'll call it SSE. Such an SSE could actually lean on existing MIIs, the existing market infrastructure institutions. You have a functional ecosystem of trading, clearing, settlement in equities, for instance, and there is no reason why a new stock exchange should not lean on those standardized procedures. Investors are familiar to that framework, that ecosystem, and it's relatively easy for them to to ride on impact investments as an asset class. But I should be careful. What Mahesh said, there is, and Abhilash sort of underlined, impact investment is not an asset class. You can be into investing into equity, investing into debt. You should rather see impact investments as a mandate. And so long as there is added recognition, added awareness of what would be the direction of our investments going forward. And there is, to some extent, a herd effect here as well. Mr. Singh pointed out how while India is reducing emissions by a gigaton, so is Walmart. Walmart is a private company, and that shows some significant levels of commitment. Now, if I look at how you could want to really make impact investment mainstream, there could be several other things, apart from the just riding on the same ecosystem, standardization to the extent that Abhilash pointed out. One could, for instance, look at expanding, more market-based innovations. So you need products which will basically allow the investor to realize the same kind of returns that one does from, standard products. Mahesh made it quite clear that returns in India on impact investment mandates have been, fairly high. IRRs have been in double digits, and not just that. One of the myths that he busted was on how the investing horizon need not be very long. So if you conflate that with market-based innovations, allowing a wider set of mechanisms, that would entail, in turn entail much broader participation, from new investors. We have a significant jump in retail investment in this country over the last 2 years, and many of them, the age bracket that they belong to, the new demographic, favors or has a better awareness about climate than others. So I think those market-based innovations would do fairly well. One has to also look at transparency measures. So it could, for instance, standardize dual performance metrics relevant to India at a sector same level with local and global industry bodies. It could then collaborate with credible third parties like credit rating agencies, CAs, to measure, audit, and report this impact. So Abhilash, I think, pointed out Mr. Singh actually pointed out how there are companies that now measure impact. So that this will allow this transparency will actually allow investors more confidence to get into impact investing. Then you have to expand funding as well. So you have to look at additional sources of funding. You have to look at how the CSR mandates of corporates could dovetail into impact investments as well. How you could probably tap into government for creating a sort of bottom of pyramid fund of fund. This is again something that has been sort of talked about. And then I think one of the important things that you have to look at is how do you get talent? How do you garner and engage talent in a way that will look at impact investing to be a thriving and viable ecosystem? So one has to attract good talent. One has to develop that talent. We're facing a major crunch on ESG at the moment, and impact investing is one part of it. It will really be some time, in my understanding, before we have a large enough pool of experts that could look at impact investing in a meaningful way. So we have this considerable problem. We have impact investing that's meaningfully growing. We have a space that's ready for impact investing at a time, and then we don't have talent. I think improving that talent would be clearly important. And lastly, I would say one has to improve governance. One has to improve reporting. There are no two ways about improving reporting and transparency. That has to happen at the beginning, and it has to set a standard. This is not your mainstream investing. Yes, while the profit motives are aligned with impact investment and normal investments now, I would say just normal mainstream investments. But transparency is where things really move up. So long answer, but what I wanted to say was there is a long way to go towards making impact impact investment mainstream in the country. But I'm happy to say we are on the right track. We are in the right direction.
Mm-hmm, mm-hmm. Thank you. Much appreciated. This was definitely a lot of insight from also Stack Exchange perspective. So Damandeep, our listeners are basically keep asking questions specifically for you. So this one is specifically for you. Given your experience with CDP, what are the externalities preventing businesses to become their best shade of green? So the question is mainly about what's wrong with the externalities and how they impact the investment.
Well, it's essentially, Kubra, that there are no consequences of not being green. Okay, right now or till now, and in terms of, and most of the companies that are doing it are either ones that are trying to attract foreign funds or have foreign investors, or are looking for markets abroad, which are premium markets. So it's essentially that it's been driven from that. The local pressures on that is sadly not so prominent. And we need our FIs to band together and to come up with these norms, as I mentioned. That's sort of the major thing. I'm happy to hear Mr. Patnaik speak about these things. NSE who's doing this. And we've had at CDP, when I was there for 5 years, we had an MOU with the Bombay Stock Exchange. Mm-hmm. And I made sure that the launch of our report was at the stock exchange to send a signal to the companies. So leaders and thought shapers like NSE, when they step up and say this needs to be done, and openly in the public platform, that needs to be done. Titankar makes a good point that there is no talent that's available, but that's what I also told a lot of the people, that this is a fantastic new field which is emerging. Standards are being set as we speak. The IISB has just been set up, so there are no established experts. If you are open to learning and being nimble, you can learn and pick on this very quickly. So, that's sort of, it's actually a very exciting field in that sense, that you can learn and move along these lines and learn very quick, because there are no established experts. And the thing is that it's not just a dry, financial point of view or the accountant stepping in. When the accountants step in, things will happen. Who amongst us has not had difficulty in trying to explain why that expensive dinner had to be taken during a business trip and so on? When you have to explain to the accountants, you do things that you need to, right? So but more than that, and that's why I brought in the story about Tata Motors and some of the others, is that you also need storytellers. You also need to chart the course of the change for people to believe in and to do that. So that's what it is. And Indian companies, they will need to be move along this journey, and to do that, and somebody needs to understand these. Now, there is very little to correlate these things, but to me, it was a fantastic story that last December, the chairman of the Tata Group took a delivery of their EV vehicle, which is not a luxury car, the Tata Nexon, on the same day wherein their rival, another automaker, launched a diesel SUV in the market. So I would encourage people to, it's also a query. I won't name the company, but to search it. They launched a diesel SUV on that day. And the chairman of the Tata Group takes delivery of an EV, which is not a luxury car. To me, that sends a very, very strong signal to the market and to people who want to see. So we, as some people, need to weave those stories and to bring those out in public and to do that. Mm-hmm. I hope that answers the question. I haven't gone too much on a tangent.
Yes, very well. Thank you for answering those questions on the spot. We really appreciate that. Okay, I will do 2 final questions, and then I think it should be about time to maybe stop the panel. So I have one question from Shalini Kalra Sahi, and that I will try to answer that quickly. Which I think that you all actually have answered probably in a better way, but I will try to give a quick answer to it. That question was, what would be the main difference between impact investing, sustainable finance, and ESG investing? I think we kind of all have talked a little bit about it, but for our listeners, at least from my perspective, impact investing is really about measuring much more the impact on the society. So if you are an asset manager and you are trying to go with impact investing as a philosophy to manage your assets, you are, for example, just to give an example, if the corporation says that you are promoting better economic activity in a low-income community, then you actually have to prove it and show it with numbers. And also your fund needs to have that impact. So it's really more about measuring and quantifying the impact of the investment. Whereas ESG investing, sustainable investing, and so on, various ways of other sustainable investing, you can simply say, I will not be investing. You will take certain assets and you will simply not choose not to be on those assets. And, that is considered also sustainable investment, which, for example, if it's guns or tobacco or whatever you think that shouldn't be belonging to your portfolio, or you will look at the sustainability ESG metrics of various companies and compare them. So I think the main difference for impact investing is really much more about measuring the impact on the society. So please tell. It's open to your discussion as well. If you have a better idea, or if I said something wrong, please correct me. But that's how I would define and answer that question. Was that fun?
In my humble opinion, I think you articulated it quite well, Kubra.
Okay. All right. Now, for time concern, I will ask, I have one more final question that I will address, and that I will ask Tirthankar to address that once and suddenly. Let me just find it. One second, I had it. I think we are done, actually. Tirthankar, did I mention about any other question to you before that you wanted to answer?
No, not specifically. Okay.
I think actually, I just realized that we have covered. From what I have at the moment, we have covered all of the questions. So I wanted to ask one final question to Tirthankar, but I think that I just realized that we have already covered. I already asked it to everyone. So I think this would be maybe a good time to start finishing. So we really appreciate that everybody listened and had also engaged and had questions for us. So thank you very much. Tirthankar, would you like to do some closing remarks, maybe?
Sure. On behalf of NSE IFSC Buzz on Earth, I would like to thank everyone for attending this webinar, and it is live on our YouTube channels as well. In terms of thanks, I would like to thank Damandeep. I would like to thank Abhilash for taking the time out and giving us your views. Mahesh isn't here now with us, but I definitely have thanked him on site. He had to leave in a hurry. Last but certainly not the least, I would like to really thank Kubra. Thank you, for coming at such short notice and such for your insightful views. I believe if I were the moderator, I'm just in a hypothetical situation, I would have been happy to be the moderator and quiz you about all the work that you've been doing with sustained finance. And clearly, some of that is getting noticed at a global level at Financial Times. So kudos to that. And certainly, ladies and gentlemen, the topic that we discussed today is important. This is a topic that whose time has really come. There was some amount of awareness across the world. Climate change is not hidden anywhere. It is, one of the things that COP26 report. Before that, you had the IPCC report, and one of the points that it raised was in the Paris report, there were about 3 to 4 studies that actually articulated the problem with climate change, actual issues, where it actually scientifically showed. And in this IPCC report, we had a couple of hundreds. So the ramifications of climate change are there in front of us. I think the pandemic had also some role to play. Mr. Singh, made a comment that they expected the number of companies to report during the pandemic to drop, but it grew. So that was, I think something to take home for all of us. This year, that number, he says, if I remember right, sir, you said 60 to 89. Some seriously high jump. We've had the BSR guidelines coming from regulators, SEBI here, and I'm sure in a cleaner, more transparent environment, as Abhilash so rightly pointed out, impact investing could go mainstream. This is one place where people, returns are there, the horizons are manageable. Transparency should be the buzzword, especially because we are in this space. And there is a role to play for a lot of people here. There's a role to play for investors. There's a role to play for regulators, market infrastructure institutions like NSE, philanthropic organizations, NGOs, lots of them. So this is an ecosystem that's likely to improve. And I would like to thank everyone, for taking time out and sharing some thoughts here. We really go home enriched today.
Thank you. Thank you, Dan. Have a good evening, everyone. Thank you very much.
Thanks, everybody. Thank you.
Bye-bye.
Bye.
Bye.